Welcome to NeverLossTrading. Today I want to share one of our research projects with you, and we use it for day trading. What we are looking at is the crude oil chart, and it's a 2-minute time frame we are observing. So on the chart we have multiple vertical lines. Those lines signify temporary support and resistance, which is important for that day to trade. So that red and green line, they go together, and the two blue lines go together. Then we have the brown lines on the outside and the midline, the red. On all those lines we see price accumulation points happening and orient our trading towards. So, but more essential on it is that indicator which makes those orange boxes is a pure volume-based indicator. It measures the volume differential that occurs throughout the day and signifies the high and low of the price associated to the volume change. Why that? The footprint of money always has to show what it's doing with volume. And we measure the volume differential and frame the high and the low of that price. When the high or the low gets broke, that's the direction we trade. And we trade for one speed unit here, or we trade what we can read on our speedometer down here on the bottom. So let's go and see how to trade such a case. Let's focus in. Here, for example, we have a new box lined out, and immediately that box gets broke. So at that moment, where we are above that line, we should be in a trade, trading to the upside. Now we colored specifically the candles. When the candle color is blue, we have an uptrend. When it's red, we have a downtrend. We usually only trade opposite direction when we see the second different color candles. So in the case of crude oil, had we gotten into the trade here, trading to the upside, we see blue, blue. Even those filled candles, which are candles that closed lower than they opened, they are still in the trend, and so therefore we color them. So let's see. We're moving up, we're moving up, we're moving up. Blue, 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 blue. So now we get the first red candle sign. This one is still blue, second red, third red candle, but the low gets not taken out, and so we can still stay in the trade, moving and trailing up. So that would have been a huge move had we captured the entire move between $86 and $86.91. That's a $910 move on one crude oil contract only, and that would be huge. Back to the principle of how that trade works. So we have a volume initiated price frame. That means volume initiates a high or low of the candle associated with the volume change. If we have a price breakout of that box that is framed, we trade along in the direction of the price breakout, and we can stay in the trade as long as we don't see the second opposite color candle in one direction. Because at the third we should be definitely out. Yeah, or at the low of the second candle or the high of the second candle, depending on the trading direction. So here in crude oil, as said, it worked out perfectly. And let's look how it went through the day. So pretty much here we go. What do we trade here? Not much, because not much is happening. Yeah, we have a nice sideways move, and we have no break of the box in one direction until we frame the next one. So the first break of a box we have here. So had we traded that to the downside, at that point in time our average price move was about 11 cents. That's $110. So if we ended for 86.52, we would need to get out at 86.41. Yep, that reached it easily, so we could have made our money. That's surely all more complex what I'm saying here, and has to be taught and learned. I just want to show you a couple of different variations of how trades can be initiated and go through a day without using very complex systems, because you know a lot of our systems are more complex for the advanced trader, where we give price indication, put a lot on the chart, but we always try to first simplify it and then put it together. Like in an airplane, you have multiple instruments in case you need them. But for the beginning pilot, that's surely complicated to learn, but the same is with trading. At times it's better to start with simple systems, and then within getting more advanced, more instruments can be put on the chart and we can trade along with it. And you see here, price breaks to the downside, we go red, trade red, 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 and here at the second blue we should start to reposition ourselves. And again, had we traded from 87.14 and gotten out here at 86.54, that's 40-point moves, that's $400 in a matter of 20 minutes on crude oil. Wonderful, yeah? So that new system is very promising for the beginning trader to have a system with positive expectation that can be followed through and traded at ease. So let's go for a little further out. There we see also how nicely we moved from that midline to the top line, bounced on the top line, came down close to the midline, but that's not our orientation point. We go with those boxes, moved up. When the box gets broke to the upside, we trade up. When it gets broke to the downside, we trade down. And if we can do that a couple of times for $100 throughout the day, that's definitely a beautiful trade. So this is just to share one of the things we have in a box for you for tomorrow. Also to give beginning traders a chance to not be overburdened with too many things to look at. The system is not yet written up, but if you have interest in it, we definitely want to also share it with a peer group of new starters, help you to get a favorable price on it and see how you proceed with it. Have a good trading day, and thank you for listening to Never Lost Trading.